Trading Psychology. Introduction to the module. Benjamin Graham, one of history's most celebrated investors, was not alone in recognizing that the investor's chief problem, even his worst enemy, is likely to be himself. Equipped with the soundest risk management rules, the most reliable information, and the best technical indicators, some traders will still be unsuccessful because they cannot get out of their own way. Our human psychology has a way of making the wrong decision seem right. So, unless we can bring it under control, it has the potential to undermine our success. This module will describe the elements of human psychology that most frequently impact traders' behavior and provide recommendations to contain them. Loss aversion. Textbook traders are focused, rational, and disciplined. Human traders regularly ignore their self-imposed rules, downplay information that doesn't suit them, and try to double-guess mathematical trading systems. The consequence of this behavior is frustration, anxiety, and poor performance. Consider a trait to which almost all traders seem prone: loss aversion. This term describes a tendency to perceive losses with approximately twice the intensity of gains of identical magnitude. It is this exaggerated dislike of loss that encourages us to avoid realizing losses, push stop-loss orders away, be willing to take disproportionate risks following a losing trade in an undisciplined attempt to make losses back, be excessively fearful of seeing an unrealized gain turn into a loss, be overly quick to take profits, be less willing to take risks following a successful trade. This kind of behavior doesn't create any internal conflicts because the wrong decision can disguise itself as the wisest choice using readily available arguments. Taking profits now doesn't satisfy my 4:1 reward-risk ratio, but 3:1 isn't bad. The unemployment number isn't as bad as I thought, but everyone knows that US underreports joblessness. I'm wrong to hold this long position, but I'll wait for the next price bounce to get out. I should get out of this short position, but the rumor is that the central bank is about to sell. The price can't keep falling like this. That bumper retail sales report ought to lift prices. The emotions of trading. Emotions are intense experiences or feelings such as pride, vengeance, self-loathing, fear, and envy. They are usually short-lived, unlike moods, which can last hours or even days, but they can nonetheless impact our trading behavior. Negative emotions. Among the most damaging aspects of negative emotions is that they disrupt our ability to learn from the past. All learning, whether it is learning to speak or learning to ride a bike, requires accurate feedback about past failures. The feedback allows us to correct our behavior and so avoid the same mistake in the future. Intense emotions can be useful in that they highlight those learnable lessons and allows us to remember them more easily. In trading, however, those emotions can often distort the feedback and deny us the opportunity to learn. For example, if we apportion blame in the wrong place because of anger or pride, we can learn nothing. Positive emotions. One might imagine that joy is among our positive emotions. Yet, joy often has its roots in darker feelings, like envy and schadenfreude, when we compare ourselves to others. So, we experience joy not necessarily when we win, but when we win more than the next person. We can even draw satisfaction from others' losses, although we have earned nothing. Stress and confusion. In trading, there is no surefire route to success. The only certainties are the inescapable trade-offs, like reward risk and win-loss, and the dangers of not respecting the rules of prudent risk management. Yet, the trading environment is full of chatrooms, forums, and signal providers who claim to be able to sidestep these certainties and still deliver results. There is nothing wrong in trying to learn from the experiences, especially the negative experiences of others. It is widely available and it is free. But do not be fooled into thinking you can avoid the risks and the trade-offs. Using emotions. Emotions can burn the details of an event in your memory. To paraphrase the poet, Maya Angelou, you will forget what the market said, you forget what the market did, but you will never forget how the market made you feel. It is essential, though, is that we remember the right lessons from those experiences. Often, this requires a little distance. After a losing experience, try taking a break. Examine the chain of events only once the sting of loss has subsided. You can then attach the right lessons to the now unforgettable emotion. Gaining confidence. Novice traders will sometimes try to gain experience and build confidence by paper trading. They simulate real trading by executing trades on a fictitious account with pretend capital. The exercise is typically successful, one profitable trade after another, and confidence grows. Yet, when they start trading with real money, losses accumulate. Paper trading is an excellent idea. It allows traders to become familiar with the trading platform, the quoting conventions, market volatility, etc. However, the confidence that grows from these fictitious transactions is thanks to traders' plans, not to their skills. Paper traders' intention is not to lose any money while they learn. The phony trading account enables them to do precisely that. As their plan works, they grow more confident. In real trading too, traders must have a plan. Once they see that their rules and criteria enable them to manage the risks effectively, confidence will grow in the same way. Good trades and bad trades. Taking profits early and letting losses run, the two behavioral consequences of loss aversion, are both damaging to long-run trading performance. The latter, though, seems more difficult to remedy. Some might say it is twice as difficult, given the asymmetry with which we perceive gains and losses. Before we start discussing how one should go about exiting good trades and bad trades, we must bring some clarity to what we mean by good and bad. A good trade is one that respects your reward-risk criteria and your risk management rules, that is, the product of a robust decision process. A bad trade does neither of these things. This popular matrix deserves a place on every trader's desk. Good process plus good outcome equals deserved success. Good process plus bad outcome equals bad luck. Bad process plus good outcome equals dumb luck. Bad process plus bad outcome equals deserved failure. For instance, trader M forgot to cancel a stop-loss order after taking profit on a short position. The price raced massively higher in response to a news release, triggering the stop and leaving M with an unexpected but profitable long position. This windfall gain is an example of dumb luck. Trades that are the product of bad processes must be closed immediately. In the short term, they can be fortuitous, but failure is inevitable in the long term. By the way, you can avoid such situations by using one cancels the other, OCO, orders. With OCOs, once the take-profit order is executed, the stop-loss is cancelled automatically, or vice versa. Trader N's trade had been developing favorably, but it has since reversed direction and is now nearing the trailing stop. N needs to do nothing. If the trailing stop-loss has been set meaningfully and adjusted conservatively, it will take care of the position. Even if the stop-loss is executed, the loss will be smaller than initially thought. In the short term, the outcome would be disappointing, but success is inevitable in the long term. Traders' commandments. 1. You cannot predict the future, but you can prepare for whatever the future brings. 2. Find signals and then decide what to do, not vice versa. 3. Intuition is no match for a well-thought-out plan. 4. Trade with the trend, even if you do not yet understand the fundamentals driving it. 5. Trust your strategies if they satisfy your reward-risk ratio. 6. Always have a plan, including one for equipment failure. 7. Adhere to your money management rules. 8. A complex trading strategy is not necessarily better than a simple one. 9. You will not get rich quickly with forex trading. 10. Try to keep your emotions in check. Become a pro. As in any other job, to be a successful forex trader will require the commitment of your time and the right tools for the job. Of course, market liquidity will determine at what time during the day it is best to trade. However, this must dovetail with the responsibilities you have away from trading. It is unreasonable to think you will be able to abandon your other commitments, family, friends, study, recreation, etc., to trade forex, or to think you can attend to all at the same time. You will also need reliable equipment, for example, computer, broadband internet, comfortable chair, distraction-free environment, etc. Trading opportunities arise every day, so there is no rush to deal all the time. But when they do appear, you must be paying attention. Do not trade if you are not entirely focused. Summary: it is impossible to switch off our emotions as soon as we sit down in the trader's chair. The perceptions that underlie behaviors like loss aversion are robust, widespread and tenacious. The only way to prevent them from gnawing away at our trading profits is to establish strict rules of conduct. Well-thought-out plans and strict criteria must be the basis of the decision process. Good decisions are the product of good decision processes, even the ones that have bad outcomes. Good decision process will lead to successful outcomes in the long term. Bad decision processes will lead to adverse outcomes in the long term. Intense emotions impede learning.